Accountants have a tool for looking at the performance of an organization across a period of time, like, say, from the beginning of November to the end of November, or from the beginning of the quarter to the end of the quarter, or maybe even just last week, or in some cases, the entire calendar year, or maybe even tax year. So that particular document that really looks at income and expense and revenue for that period of time is called the income statement. If you want to learn more about income statements, stick around. Financial statements have many parts. One key part is the income statement, which tells a story. While the balance sheet marks the financial condition of the firm at a specific point in time, the income statement contains all of the income-related information for a given period of time. I want you to think of each line in the income statement in terms of good news or bad news. Good news refers to any item that increases your firm's profit, while bad news decreases profit. The income statement starts by reporting revenue or sales on the top line. We have specific rules about what constitutes revenue and under which conditions it can be recognized. We will explore that topic in greater detail in an upcoming video. But for now, think of revenue as how much you charged your customers for the products or services you sold them. Now think of that in terms of good news or bad news. Obviously, selling more product or selling at a higher price is good news. The next section of the income statement focuses on expenses. The first expense is called cost of goods sold. Cost of goods sold, or COGS, refers to the cost of the product or service that you sold. Some companies call this cost of sales. Obviously, costs are bad news. Gross profit is the revenue minus COGS. This represents the value that was created or destroyed by the production and sale of your product. However, it only considers product-related costs, materials, labor, and overhead, such as the cost of the materials you used in the manufacturing process, the costs associated with paying your employees that built the product, and other costs associated with production. It does not include things like advertising, sales commissions, interest expense, or taxes. Accounting has a rule called the matching principle. This states expenses associated with the sale must show up in the income statement, or in accounting terms, be recognized in the same period as the revenue. So product costs are classified in the inventory accounts when incurred and stored there until we sell the product. The costs then move to COGS, where the sale happens. Everything not required for production must be expensed in the period they are incurred. These non-production related expenses are called period costs, operating expenses, or SG&A for selling, general, and administrative expenses. These costs include advertising, sales commissions, executive compensation, and any other costs that are not required for production but are incurred by the company to operate normally. Once we subtract operating expenses, we are left with operating income. This is the profit your company makes from its normal operations. From operating income, we subtract interest expense and income tax to get net profit. Net income, like revenue, is good. However, note the difference between the words net income and revenue. Revenue is the value of what you sold. Net income, or profit, is what you have left after you paid for what you sold. Don't confuse the two.